In terms of the Bitcoin ETFs, I think they are illustrating that, or the Bitcoin treasuries, they are illustrating that at least in the treasury market, for whatever reasons people choose to buy MicroStrategy, maybe it now is offering a yield curve with its debt strategy for Bitcoin. So that's kind of interesting. But these are winner take most opportunities. We think that the companies that allocate assets to these new instruments, that the one that moves the fastest, the most aggressively, is probably going to win the lion's share. Maybe it's geographic. I know Metaplanet in Japan has done well, but MicroStrategy is king of the hill, obviously, here in the United States.
Cathie Wood has never shied away from bold bets, and her latest take on digital assets is no exception. She sees the landscape as one where conviction and timing matter more than anything else. On Bitcoin ETFs and corporate strategies, Wood points to MicroStrategy as the clear leader in the US. Its debt and treasury approach has essentially created a yield curve around Bitcoin that no other company has matched. In Japan, Metaplanet is moving quickly, but in her view, these are winner-take-most markets. The first movers with real conviction usually capture most of the upside, and MicroStrategy set that standard. When it comes to Ethereum, Wood says ARK avoided the ETFs for one reason: they can't stake. Since staking is central to Ethereum's value, those funds didn't provide the right exposure. Instead, ARK leaned into miners building positions in companies like Bitmain Immersion after its sell-off, and they also added Solana exposure. In Wood's eyes, the firm now holds the big three in crypto: Bitcoin, Ethereum, and Solana, each serving a unique role in the emerging system. At its core, Wood says ARK's strategy is simple but aggressive: lean into the new financial rails, stablecoins, Bitcoin, Ethereum, Solana, while backing the companies and structures that move first and move decisively. For her, that's where the long-term compounding gains will be. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
I will say you'll see that we have backed DATs and Circle, so we're very well exposed to this crypto cycle. We think stablecoins generally, and of course Tether and Circle, have 90% of the stablecoin market now. We think that is a very important entree. The holders of stablecoin will have an entree into the DeFi ecosystem, so decentralized financial services that will now take place on public blockchains. So we think that's really the definition of the next generation internet. It's the layer of the internet that was not built early on, because in the late 80s, early 90s, no one expected financial services to take place on the internet. So finally, 30 years later, we're getting the layer of the internet that is going to enable it. Yes, well, one of the reasons we did not choose to invest in one of the Ether ETFs is, at least as of now, they will not be allowed to stake. And we think staking for yield is a very important part of the Ether Ethereum story. We were having a lot of trouble, therefore, getting access to Ether in our portfolio. So when Bitmain Immersion came along, we thought that would be a great opportunity after it sold off significantly following the burst. We did take our position. And same with Soulmate. We have a lesser exposure to Solana, but we now have exposure to the big three: Bitcoin, Ether, and Solana. And we think all three are going to play an important role. We have not bought a Bitcoin DAT, so I should be clear there. But Ether, yes. Solana, yes. Staking's a big answer to that question. In terms of the Bitcoin ETFs, I think they are illustrating that, or the Bitcoin treasuries, they are illustrating that at least in the treasury market, for whatever reasons people choose to buy MicroStrategy, maybe it now is offering a yield curve with its debt strategy for Bitcoin. So that's That's kind of interesting. But these are winner-take-most opportunities. We think that the companies that allocate assets to these new instruments, that the one that moves the fastest, the most aggressively, is probably going to win the lion's share. Maybe it's geographic. I know Metaplanet in Japan has done well, but MicroStrategy is king of the hill, obviously, here in the United States. The surges are solely to get into whatever the IPO is. Now, what happened is Circle, we were a cornerstone investor, $150 million, and you saw what happened to that stock. Saw no such activity around that particular IPO. However, it seemed to give, I'm going to say, market makers and others the idea that, wait a minute, if ARK can get a big allocation to these IPOs, maybe we can benefit by anticipating which ones they will get and choose to participate in. So they've been doing that. We're seeing that, but it does take a bit of guesswork, and we don't participate in every IPO. So I don't think, I think that they'll probably be a little more judicious in doing this going forward, because I think some of this trading has caught them out flat-footed.
Cathie Wood sees the policy environment in the U.S. shifting in a way that could drive both markets and the broader economy. Deregulation around crypto has already set a tone, but she argues the real story is in tax policy. For the first time, companies can fully expense manufacturing structures in the year they go into service, though only for 3 years. At the same time, equipment domestic R&D and software now enjoy permanent full expensing. Put together, this pushes the effective corporate tax rate in the U.S. down to roughly 10% over the next 3 years, making it one of the lowest globally. The implications, she says, are significant. Lower taxes and incentives for investment could spark a wave of activity, shifting the U.S. economy out of its rolling recession phase and into recovery. From there, Wood expects productivity to drive the next leg of growth. Productivity gains are inherently deflationary, pushing prices down even as output rises. She likens it to Reagan-era economics, where strong growth occurred alongside surprisingly low inflation. Looking ahead, Wood sees interest rates falling further, inflation potentially dipping below 2% next year, and a long-lasting boom powered by investment and productivity. Let's get back to the interview.
Well, we think a lot of good things are happening from a policy backdrop and therefore ultimately a macro backdrop. The deregulation that we're seeing is stunning. It started with crypto and AI. We have a crypto and AI czar now. And I think what many people have not paid enough attention to, mostly because tariffs have been getting all the headlines, given how chaotic they seem. But in OB3, so the one big beautiful bill, there was a tax policy measure that we're not sure has been integrated into many forecasts yet. And it has to do with depreciation, moving from depreciation to full expensing of structures. That has never happened before. Manufacturing structures for the next 3 years, in the first year they go into service, they will be able to expense fully in that year, as well as equipment, domestic R&D, and software. So music to innovation's ears, I would say. I think we're going to have a boom in economic activity. That first one, the manufacturing structures, is just for 3 years. The other ones have been made permanent. And so this takes our effective corporate tax rate in the United States, not statutory, that's still at 21, but the effective tax rate for the next 3 years at least is going to be roughly 10%, one of the lowest in the world. So I think we're in for some very good times. We think we're moving from a rolling recession into a recovery and then into a productivity-driven boom in activity. If you look at our performance in 2017 and 18, so when interest rate fears were rising and then interest rates rose, our portfolio outperformed in both years significantly. And 2018 was a down year. We were up. So I know that COVID, the boom bust around that time period, got a lot of people thinking, okay, inversely correlated to interest rate. Historically, that has not been the case. So just wanted to make that comment. In terms of the Fed, we do think interest rates will continue to come down. But if we're right, in 2026, at some point, it will be clear we're moving into a productivity-driven boom. What does that mean? Productivity is one of the most potent anti-inflationary forces. This is Reaganomics. It's deja vu. And you'll see back then, in the 20 years that ended in the tech and telecom bubble, real growth was very strong. And during those moments in time, inflation came down to surprisingly low levels. And we think that's going to be true next year as well. In fact, we would not be surprised to see inflation well below 2% next year. Well, I do think there's been a lot of uncertainty, geopolitical uncertainty especially. So it seems as though there is a barbell strategy going on here, which is equities to take advantage of lower interest rates and potentially the economic environment that I just mentioned. And then gold, just as a hedge, it seems to me. And the same has been true of crypto assets. They are much more volatile than gold, but they have also done well over time. So I think this really is a barbell strategy. Most wonderful things about ETFs as a portfolio manager is I don't have to worry about flows. With mutual funds, the portfolio manager has to worry about flows. But the market around us, facilitating ETFs, market makers, authorized participants, it's fantastic. They handle all of the flows.
I see.
They're using all kinds of instruments, and we don't have to worry about it. So, I don't bother about it.
What stands out in this moment is how two powerful forces, technological adoption and policy change, are starting to intersect. On one side, digital assets are maturing into structured markets with leaders that have already established durable positions. The path carved by companies willing to commit balance sheets and strategies to crypto is beginning to look less experimental and more foundational. On the other side, tax incentives and investment-friendly rules are reshaping the cost of capital, giving businesses a window to expand, innovate, and push productivity higher. That blend of conviction-driven corporate bets and supportive macro shifts creates a backdrop that could alter both financial markets and the real economy for years to come. Unlike past cycles where speculative manias faded as quickly as they appeared, this convergence suggests the groundwork is being laid for structural change where digital assets, investment incentives, and technological gains reinforce each other. If productivity does accelerate while new financial rails are built in parallel, the compounding effects could be profound, reshaping not just returns for investors but the competitive position of entire economies. The real question is whether this combination of crypto adoption and pro-investment policy represents a fleeting alignment of circumstances or the beginning of a longer phase where digital markets and productivity-driven growth move hand in hand. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.